Hey, Jason here. Today I want to introduce our new series to you, Uncommon Investing Terms. Uncommon Investing Terms, our new series. In this series, we're going to be talking about, of course, uncommon investing terms, why they're important for you, what they mean, why they're important for the investment analysis, how you can gain a huge advantage in some cases knowing what these mean, how you can avoid potential red flags by knowing what these mean and what these show for companies. You'll learn all that and more in this brand new series. Today's uncommon investing term, we're going to talk about retained earnings. All you need to see this is Morningstar's free website, a company, put a company sticker in. I'm doing Disney just for these purposes of this video. And you go here, click on the financials tab. I'll just show you. Click on the financials tab. Click on the balance sheet. And scroll down. Retained earnings is always at the bottom, right here. We'll talk about accumulated deficit in another video. For today's video, I want to concentrate 100% on retained earnings. Retained earnings are the earnings left over on a cumulative basis every year for a company's profit. So if a company earns a net profit of $1 million in one year, and the next year they earn a net profit of $2 million, they would have retained earnings of $3 million. These build up over time. Generally, you want to see this going up over time, because if it's going up over the time, it means, of course, the company is profitable. If it's going down over time, it means the company is not profitable. And if it's going down enough to where it's negative, it's accumulated deficit, which again, we will not talk about in today's video. We'll talk about another video in this series. So what are retained earnings? That's kind of the book definition of retained earnings. Why is retained earnings important in a real world kind of analysis situation? If you come across retained earnings, why is it important? It's important because it immediately shows you kind of the built up profits over the long time period of the company. And what I like to call this when I talk to private businesses that I advise, or when I look at a stock, is this is kind of a rainy day fund. This is akin to, in the United States, again, if you're around the world, we have a lot of viewers from around the world. If you don't have that saying, I'll explain a little bit more. A rainy day fund is essentially you put away money for a rainy day or a bad day, and you can spend it at that time when needed. So this, I like to look at retained earnings as a bit of a rainy day fund. I also call it the business savings account, because this is essentially, again, over time, the profitability of the company. So what that means is the company should have this much amount, or should have this amount in Disney's case, 82, I think this is in billions. Yeah, billions. $82 billion worth of profitability built up over time. So it could have used this profitability to grow operations, to acquire companies, to buy back stock, to pay dividends. And it's done all these things. Retained earnings over time gives you the ability to do these kind of things without taking on bad debt, without issuing shares and diluting shareholders, and doing those kind of things that are generally negative unless done well by great capital allocators. Generally, you want to see a company as profitable. Again, barring some kind of NCAV situation, you want your investments to be profitable, because if they're profitable, in this case, retained earnings is what we're talking about. If they're profitable over the long time period, they can use that money to reinvest in the business, to acquire businesses, pay dividends, buy back stock, do research and development, whatever the case may be, buy patents, whatever the case may be. They can use that profitability from the business operations to fund expanding those business operations. That is the importance, or that is why retained earnings is so important. Because if a company doesn't have this, and again, it's accumulated deficit, which we'll talk about in another video, the company has, this goes negative. If it's negative, that means the company's been unprofitable for a long time and has destroyed value over time. Destroyed value over time. Another way to look at retained earnings is the opposite. It's created, in this case, almost $83 billion worth of value for shareholders, at least in terms of net profit. Those are the most important things about retained earnings, why this number is important, why you should know what it is. You can gain a ton of information just by scrolling down here about Disney. So for example, when I see this number, I look at it kind of over time. Let's make sure this is the annual numbers. Yep, annual numbers. Okay, so over time, over the last 5 years, Disney's created $30 billion in net profit. That's absurd. That's absurdly good. So that immediately tells me that on average, over the last 5 years, Disney's produced about $6 billion in net profit. You can decide whether that's good or not, but if a company, in my opinion, can produce $6 billion in profit, that's generally a good thing. Obviously, I don't use net profit a lot in terms of the absolute number. I rely more on operating profit and free cash flow. But in this case, you can still gain a ton of information just by looking at this. Just by looking at this, you know the company's stable. They generally they have good operations. They should have an enormous amount of cash flow coming from this. Their margins are likely high. They may have competitive advantages because most companies cannot increase profits by $30 billion in 5 years. That they likely have a healthy balance sheet. You can also tell that from this number, because if they produce on average, again, about $6 billion a year in net profits, they should have a healthy balance sheet. Disney does. You can tell all that from just this one number, and I'm going to prove that to you with, where's the debt? Debt. So 3.7. So they have about $20 billion in debt for what size is the company? For $20 billion in debt for a $265 billion company, that's pretty much nothing. Again, especially when compared to the profitability, when you're producing $6 billion in net profit per year, again, retained earnings for a $20 billion or a $265 billion company, that's nothing. They can more than cover that debt. Cash levels, again, they have about $4 billion in cash. So you can tell all of that just from this one number, just from retained earnings. All these important things. This is how I save an enormous amount of time when I research companies, because I know what things mean like this: retained earnings, accumulated deficit, what it shows me, the good things it shows me, the bad things it shows me if it's accumulated deficit, where I need to look for further clues, potential red flags, potential great hidden assets. In some cases, again, we'll talk about all those kinds of things and more in future videos in this series. But for now, I hope you enjoyed this brief training on uncommon investing term, retained earnings. If you have any questions, let me know in the comments below. If I missed anything, let me know in the comments below. If you're watching on YouTube, make sure to subscribe and hit the notification bell so you are notified anytime we release a new video, and releasing new videos all the time. Again, just in this brand new series, this is the first video in this series. We have 10 to 12 videos just in this brand new series, and releasing two to four videos a week on the blog and on YouTube. Thanks for watching. Hope you have a great day. Talk soon. Bye.